The stuff that I talk about in this video is probably going to change your perspective on what reality looks like for 99% of people here in Australia, and it's quite sad. But if you're watching this and you're not 65, then you still have time to actually change shit up. So let's dive into what my thoughts are around how you can retire wealthy, and I guess the title of this video is Filthy Rich. If you're interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. It's fair to say most people are getting caught up in the short term, inflation this, inflation that, but the reality is only a couple of years ago, we're in deflationary times. And yes, we have had the government print a lot of money, but that seems like old news now. Let's adapt, let's continue moving forward because everything works in cycles. Things go up, things go down. It's just a matter of who adapts quickest and who is open-minded enough to take the risks, as well as having the right savings principles to back you up in case anything goes wrong. When we think about investing, we are thinking about investing for now, but the reality is we get the benefits of that in a couple of years, and more notably in our retirement. Now, for some people, they will retire in their 40s and 50s and they'll be very, very happy because they made the choices in their 20s and 30s while most people were watching the headlines and saying, nah, I ain't gonna do that shit. But I want you to focus on why it's so important to start early and what the average is gonna look like. And it's pretty scary because although inflation is supposed to be 2 to 3%, I honestly believe it's a lot higher than that, and that's why we see our grocery bills so much higher, not just right now, but even a couple of years ago. It's been the same story. With house prices also increasing, if you don't own your own home or you don't have any assets, you continue to fall further behind. And to really understand the severity of this point, look at inflation versus wage growth. One of the major factors that affect Australian household savings is the fact that the nation has not recorded real annual wage growth since March 2021 quarter. With inflation outpacing wages growth ever since, that means Australian workers have been effectively earning less money. In a second here, I'm going to break down what that means. But what you can see here in the green line is inflation, and here in the black line is actually wage growth. So while you have the government coming out saying, hey, look, we've got wage growth that's so high, it's been the highest for like the last 10 years, it doesn't mean anything because inflation's a lot higher than where it has been for the last 10 years as well. If inflation, being the cost of everything going up, goes up by 7% and your wages grow up by 3%, you're actually making 4% less that year. And the opposite happens when your wage growth is higher than inflation. So for instance, if you move jobs, you get promoted, or you move companies and your wages increase by 10%, yet inflation is say 5%, you're actually getting further ahead by 5%. Where this really starts compounding is when you can use that income to go and invest. Most people won't do this. Most people will go and buy their own home because that's what we got taught was the right thing to do. And instead, the rest of the money is used to go out and splurge on living life. At the end of the day, we get 4 weeks a year to go out on a holiday. So people will go and do that rather than really knuckle down, get the right principles in place for the first 5-10 year block and go out and build that wealth. Once you have the assets to then give you the income to be able to enjoy life and invest even further. If you're interested in what my thoughts are around the middle class, definitely go check out this video because it's quite damning. Until you've seen it, you haven't really seen the effects of it. Now here in Australia, we are fortunate that we get the pension. So if you get to like 65, 67 and you meet the asset test and the income test, you can actually earn an income from the government just by sitting at home. And it's actually a pretty good system here in Australia. The government age pension is also available to those who meet the income and asset tests. The full age pension is currently about $26,689 yearly for singles and $40,238 yearly for couples. Depending on your income and assets, your age pension entitlements may be reduced, or if they are above a certain level, you may not be eligible for the pension at all. Each dollar they earn over $190 per fortnight for a single person will reduce the age pension by 50 cents. Each dollar of combined income over $336 per fortnight for a couple will reduce their pension by 50%. If you're a single homeowner with more than $622,250 in assets, or a homeowner couple with assets of more than $935,000, you will not be eligible for the pension, full stop. When I mention these numbers of $622,000 as a single or $935,000 as a couple, you've got to think this is the asset value outside of your own home by the time you get to 65, 67. So if you started working in your 20s, you've had 40 years to accumulate wealth. Now I get it. Some people will never get to this point and they can enjoy the pension. But if you're watching this channel and you're in your 20s, 30s, 40s, and now I'm going to even say 50s, then you're not prepping yourself to go, how do I earn the pension? You're going, how do I create my own system to earn the pension that I generate from my own investments? That means you're not having to live life on $40,000. If I spend more than that, I don't have enough money. You can go and spend whatever you like in line with what you've invested in properly. And this is the first key breakthrough in your mindset you need to have. If you're going on life and saying, hey, it's fine, I'll get the pension later on, the pension might seem okay right now, but when you've got high periods of inflation and the pension inflation doesn't keep up, although you think that you would only spend $40,000, if inflation goes up by 10%, that $40,000 only buys you 10% less, which is about $36,000 worth of actual goods. Now you're out of pocket by $4,000. So here on the Money Smart calculator, I wanted to figure out, how do we plan for retirement? So I'm gonna have some assumptions here, and of course you can go onto the calculator yourself and change these numbers. But if you're 35 and you make $120,000, you have the desire to retire at 67. You're in a couple and your super balance is about $40,000. Your employer contributions are 11%. Now you have your partner who's also 35, makes $120,000. Everything is exactly the same. What would this actually result to? Well, it means that your super balance at retirement is going to be a whopping 1.29 million, and this is made up of your balance of 645,000 and your partner's balance of 645,000. That's cracker. However, based on this, if you guys retired at 67 and you drew down a wage from your super and didn't have it actually invested, it just sat in a bank, and you were like, I'm going to take money from that super, I'm going to be able to live all the way up until 91. By 92, you will run out of money. Now with modern medicine, and we understand that we could probably live for a lot longer, what happens at 92? You run out of money, you have nothing else there, and this is all based on the fact that you have a house that's completely paid off. It's about to get scarier. The Finder survey, which asked 1,000 people what it took to be rich, and found that earning $336,516 per year was the magic number. In Australia, 52,338 is the median personal income according to the ABS, which means effectively most people think in order to be filthy rich, you're going to be making $336,000, and that's probably per person. So collectively 700,000 or thereabouts. Now, if you think about your pension and what you're actually going to be making if you were just retiring with a house and you were going to work on your super, you're probably retiring on about $40,000 to $50,000 each. That definitely doesn't sound like filthy rich, right? And you came here to understand, how do you get to filthy rich? How do you get to the point where, yeah, you might not even retire at 67. You might retire at 45 with a lot less income, but you'll rather do that because you just got 20 years back. Whether you spend that with family, whether you take care of your own health, or whether you continue working and you actually retire at 67, there are other choices. Now, being a real estate channel, I wanted to focus on real estate. And I'm not talking about, hey, buy 10 properties, buy this, buy that. You can check out a video here where I break down all that for you if you want to retire at that level. In fact, you'll probably get to retirement within the next 10 years if you were to follow the stuff that I talk about in that video. But here, I want to focus on 2 investment properties. Sounds simple, right? Your whole idea or your whole strategy is around 2 investment properties. And why 2 investment properties? Because I wanted to show you the difference, just 1 year of working hard to the rest of your life. You might be in a position now where if over the next 12 months, with the savings you have, with the savings you can generate, and with higher incomes that you could generate by changing jobs, you might be in a position where you could purchase these 2 investment properties. So I've put here in this calculator, which is the compound interest calculator, $900,000. So you go out, buy 2 properties, each one for $450,000. You go out there and it's growing at 7% yearly. Now, if you need help in actually finding these properties and doing it properly, check out this video. It's about how you actually go ahead and find property and do it the right way. But if we did this for over 30 years, what would that look like? So if you started this at 35, in 30 years time, which would be at 65, all you had to do was buy these 2 properties, which would then pretty much take care of itself. You would be in a position where your future investment would be worth $6.851 million, which is a 661% return on investment. What's crazier is that return on investment is actually a lot higher, given that you didn't actually have to put all of that money down. You're not going out and buying a $450,000 home with all cash. You're probably putting a 10 or 20% deposit down. So your total cash outlay to buy the 2 properties are like $200K. So from $200K to generate $6.8 million worth of equity is what you're looking at in the space of 30 years. Did you take much risk? No, because you bought 2 properties and you probably bought them in 2 different locations. And if you had the right help, you got it at the right part of the cycle as well. And when you put this into context, you're like, if I've got these 2 properties, I could go ahead and just sell the 2 properties. And now, yes, we've got to account for inflation, right? So let's say inflation wiped off half of those gains. So you're only really growing at 3.5% every year. You end up at 6.8 million, but the purchasing power is more like 3.4 million because we've wiped off 50% for inflation. You would still be in a better position than if you were to just go out and simply say, okay, I'm going to continue saving and that's all I'm going to do. And the best part about this is that you could go and do this for 1 year, and then the rest of the 29 years you can focus on savings, you can focus on other investments, diversify your portfolio, and go ahead and buy your own property. Now you're in a position where even if you took the $3.4 million, you sold your 2 properties, put it in the bank account, and earned like 4%, you'd be making about $135,000 to $140,000 a year. And you wouldn't even have to be touching your original principal. And when you look at it as a couple, you're earning about $270,000 together. And this is accounting for inflation. So if you actually use the numbers, it would work out to be $270,000 per person, which is close to about $540,000 $100,000 a year. This is absolutely insane, and it actually works because we've seen people grow their portfolios over 10 years, 20 years, 30 years. And if you decided you wanted to do this and retire in your 50s, you could. You just end up selling for a lot less, you end up making a lot less, but you just got 10 years back of your time. Now, to me, filthy rich is retiring on your own terms earlier than 65, because time is something we can never get back. Money you can always make more of, but time you can never. It's only one way. Now, yes, you can go and buy convenience. You can have a chef that cooks food for you. You can have a cleaner that cleans for you, but the time keeps ticking, which is why we need to go out there today, start building our wealth, because retirement is going to catch up to us very quickly. And with everything that's uncertain in this environment right now, I can tell you now, I sleep a lot easier knowing I've got assets versus not having assets. And despite having debt on those assets and interest rates going through the roof, this is short-term pain. And I've always said on this channel, if you can weather the short-term pain, the long-term gain is why only 1% are going to be able to enjoy a life that's totally fruitful and filled with financial independence. I hope you guys have enjoyed this video, and hopefully it's been eye-opening for you or for someone around you. Definitely go share this video, and I'll definitely go check out the other videos that I've got on this channel. Thank you so much for watching. I'll catch you guys in the next one. Thanks, guys.